The IRS has issued instructions on exactly how to exclude $10,200 of unemployment compensation from your 2020 taxable income. The instructions are a little bit weird, but they're not too hard. I've got all the details for you in this video. Hi, I'm Steve Hunt. I'm a certified public accountant, and I'm the consultant for prosperity and adventure. I'm the expert at helping people like you reach your dreams faster. I'm also the owner of collegetaxrefunds.com, where we help recent college students and their parents and families claim thousands of dollars that they don't even realize that they missed on their old tax returns. So if you have a recent college student in your family, please have them check out collegetaxrefunds.com to see if they missed money on any of their taxes over the last 3 years. We can help them get the money they missed. Today, I wanted to talk about unemployment compensation, unemployment income, and exactly how to exclude the $10,200 that you're allowed to exclude from your 2020 taxes. So I have already made 2 previous videos about unemployment compensation, specifically about how and why the American Rescue Plan Act of 2021 allows you to exclude $10,200 of unemployment compensation from your 2020 income. And if you're married filing jointly, it also allows your spouse to exclude up to $10,200 of unemployment compensation that they received. I've described all of this and answered several other questions in those 2 videos, so I do encourage you to watch those videos. I'm going to be putting links on this video to both of those other 2 videos. Please check them out if you have any additional questions after you've watched this video, or you can go check them out right now. But you can also put any questions that you have about unemployment compensation or about taxes in the comments below, and I'll answer them in the comments, or I may even make a video about it. So once again, I want to talk to you today about exactly how to exclude this income. The short version of what's going on here is that because of the COVID-19 pandemic, many of us received unemployment compensation from our states, and the Congress wanted to allow you to not have to pay tax on the first $10,200 of unemployment income that you received, and then your spouse can do the same. Now, it's important to note that if you received more than $10,200, and say, for instance, your spouse received less than $10,200, you will still only be able to exclude up to $10,200 that you received, and you don't have to pay tax on that. And your spouse will only be able to exclude the amount of unemployment compensation that they received. So let's say that you received $25,000 of unemployment compensation, and your spouse received $5,000 of unemployment compensation. You get to exclude $10,200 and not pay tax on it. Your spouse, however, does not get to borrow from you or exclude some of yours. Your spouse only gets to exclude $5,000 because that's all that they received. We will use that in an example of how to claim this exclusion and report it on your taxes in just a minute. I also want to point out that the exclusion, meaning the ability to not pay tax on this unemployment compensation, only applies to your federal income tax return. It's possible that your state will also allow you to exclude this money and not pay state taxes on it, but you need to check your state tax laws to determine whether or not that income is free from state taxes. You may have to pay state taxes still. All right, let's take a look at how this exclusion works by looking at the Unemployment Compensation Exclusion Worksheet. This is the worksheet for Schedule 1, Federal Schedule 1, Line 8. You can Google Unemployment Compensation Exclusion Worksheet to pull this up. Before I go through this worksheet briefly, I want to point out that many of you you're not doing your taxes by hand. So you're not going to be filling out this worksheet by hand, and you're not going to have to read it line by line or understand exactly how it works. If you are putting your income into your tax software, give it just a couple more days. Hopefully your tax software will have an update, and it will then be able to easily exclude this money from your taxable income for you. However, if you are doing it by hand or you need to know how to fill one of these out, I'm explaining how it works right now. So it says first, you add up the total amount of income that you have from all your other sources on your 1040 and the other income that you received on your Schedule 1. And we'll look at that. You add it all up to come up with your total income. Then you subtract all of your other adjustments or deductions that you're allowed on your Schedule 1, as well as your charitable deduction that you are allowed to take right now because of the laws that have been passed. Even if you're not itemizing your deductions, you can take a $300 charitable deduction if you gave that money to charity. So you take these deductions from all of your income combined, and you come up with what's called your modified adjusted gross income. The modified adjusted gross income includes your full amount of unemployment compensation. It's added in there even before you exclude anything. Now, if your total income minus your adjustments is $150,000 or more. Whether you're single, whether you're head of household or widow or married filing jointly, doesn't matter. Everybody has the same line. If it's $150,000 or more, you are not allowed to exclude any of your unemployment compensation for 2020. It says right here, yes, it is that much. You cannot exclude it, so you got to stop right here. However, if your income, all income included, minus those adjustments, is below $150,000, now you can exclude the $10,200. And so right here, you will enter the amount of unemployment compensation that was paid to you, but not more than $10,200. So you're coming up with your total exclusion amount. Then the amount that was paid to your spouse if you're married filing jointly, and theirs is only up to $10,200. You add those two numbers together, so the maximum amount would be $20,400 if both of you and your spouse, got at least $10,200 of unemployment compensation. Then you can exclude that total amount. And here's the total exclusion on line 9, and that is the amount that now you will subtract from your other income on Schedule 1, line 8. This is kind of a weird way of excluding. Usually, when you don't have to report income on your tax return, the IRS just lets you leave it off your tax return. That's how they normally exclude things. However, in this case, they want you to report the total amount of your unemployment compensation on the unemployment compensation line, and then they want you to subtract the exclusion on the other income line. I'm putting my hands up like this in parentheses, indicating that you subtract the exclusion. This is what's weird about this particular exclusion. Let's take a look at how this works. I'm going to go to a Form 1040, and I've just made up some numbers here. Let's assume for a second that your wages for 2020 was a healthy $91,000, and that you also had capital gain income of $10,000, and you gave a $300 charitable contribution. Okay, so right now, before moving on to Schedule 1, your income is $101,000. Take away the $300 contribution. Let's go to Schedule 1. On Schedule 1, you also got some taxable refunds, credits, and offsets of state and local taxes. Again, these are just ballpark numbers, and your numbers are going to vary, but you had $101,000 of income. Now you've got another $10,000. That puts you at $111,000. And you've got business income of $10,000, some side business you're running. So now you're at $121,000. Finally, you have your $30,000 of unemployment compensation. Remember, $25,000 for you, $5,000 for your spouse. Okay, so this takes you from $121,000 of income all the way up to $151,000 of income. And now you get to subtract your adjustments or your deductions, which includes, let's say, $700 of self-employment tax right here on line 14, and the $300 charitable contribution. So we're taking the $151,000 total income, subtracting $700 for self-employment tax, and subtracting $300 for our charitable contribution, and we're down to exactly $150,000 of modified adjusted gross income. Unfortunately, according to the worksheet, if your income is exactly $150,000 or more, you are not allowed to exclude any of your unemployment compensation. So using these numbers I just provided, this person would not get to exclude any unemployment compensation at all. Let's change it by $1. And this is a very weird thing in the tax world where you can adjust your income by $1, where you can make only $1 less during the year and your taxes swing massively. That's not normal. Usually, people are always afraid of making an extra dollar or an extra $100 or an extra $1,000 because they think it'll push me into a higher tax bracket. And normally, that's really not a fear you should be afraid of, because maybe you're in the 12% tax bracket, and if you happen to make it up into the next tax bracket, only the money above a certain limit will now be taxed at the higher tax rate. Okay, the rest of your income will still remain 12%. It's not like suddenly all your income is taxed at 20% or something like that, and that it was really stupid for you to earn that extra $1 because now you owe an extra $10,000 of tax. That's just not normally what happens. However, in connection with this unemployment compensation exclusion, that is exactly what's going on here. If you made $150,000, you don't get to exclude anything, but if you made $149,999, you get to exclude, if eligible, the entire $20,400 of unemployment compensation, which could mean that you're literally saving thousands of dollars on your taxes by simply earning $1 less. This is something that it's important to know if you're around that $150,000 mark and you received unemployment compensation. It's important to talk to your tax advisor and figure out whether or not there's some way that you can get a larger adjustment, some other deduction, some other way to report your income, your business income, or something in order to bring you down below that $150,000 mark so that you can save thousands of dollars in taxes. All right, let's go to the example of what happens if we adjust the income down by $1 and see exactly how it's going to work to exclude our unemployment compensation. So on this tax return, you'll see that instead of $91,000 of wages, we got $90,999, $1 less. We still have $10,000 of our capital gains, and we still have a $300 charitable contribution exactly as before. So we're at $100,999 of income before looking at Schedule 1. Now we have the exact same Schedule 1. I haven't changed a thing. I didn't even scroll back up yet. Again, we're at $100,999 of income. We have $10,000 of taxable refunds, $10,000 of business income, which now puts us at $120,999 of income. And now we have to add the $30,000, the full $30,000 of unemployment compensation to get us to $150,999 of income, exactly $1 less than we were before. And now we get to subtract the $700 self-employment tax and the $300 charitable contribution, which puts us back down to $149,999 modified adjusted gross income. We are now below $150,000 by $1, and so now we get to exclude the unemployment compensation. Now you'll remember that when you use the worksheet, you first identify your unemployment compensation up to $10,200, and that you get to exclude, and then you get to identify your spouse's unemployment compensation up to $10,200. In this case, the spouse only had $5,000. So what we're going to put here on line 8, if you had any other income here on line 8, you're going to subtract the unemployment compensation exclusion from your other income. But we didn't have any other income here, so we're literally just going to write UCE, which means unemployment compensation exclusion, and then we're going to put the amount, which is the $10,200 you're excluding and the $5,000 that your spouse is excluding, for a total of $5,200. Now, because we are subtracting this amount from the total, we can actually put this in parentheses like that. It means I'm taking away $5,200. I'm excluding it or deducting it. And we will do the same thing over here. We will subtract from our other income $5,200, and then we will combine lines 1 through 8 right here. So this 1 through 8 is $50,000 minus the $15,200, which leaves $34,800 as our additional income. And you'll note that now we've taken away $15,200 from our taxable income. In the first example, our modified adjusted gross income was exactly $150,000. And we're going to have to go ahead and move through the rest of the tax return using that number and pay our taxes on whatever's the taxable income from that number. But now that we took $1 away from our wages and we can qualify for the very valuable unemployment compensation exclusion, our taxable income is only going to be about 100, or not our taxable income, excuse me, our adjusted gross income is going to be only about $134,000 and $799. So that's, like I say, $15,000 less, and we won't have to pay tax on $15,000. Once again, this only applies to your federal tax return. You still might have to pay the full tax on your state tax return. Hopefully you're not doing this by hand like I just did. You probably don't have to understand everything that I just explained, but I wanted to show you exactly how to exclude that income by putting UCE on your other income line and then subtracting your unemployment compensation in, exclusion. If you have any questions about this or anything else related to taxes, please put them in the comments. Thank you for liking and subscribing and sharing. Have a great day.